Thank you for joining Jennifer Schaus and Associates in our 2019 Webinar Wednesday series. We are coming to you live from downtown Washington, D.C. Our webinars are held every Wednesday, and you can find the upcoming schedule on our website. Past webinars and all recordings are also on our website and on our YouTube channel, along with over 160 other recordings on federal contracting topics. All are complimentary. If you have questions for our speaker today, you can email her directly with the contact information that's on the last slide. And this is just a little bit about us. We are a Washington, D.C.-based firm and provide services for federal contractors. This ranges from market analysis reports to proposal writing and post-award compliance. More information is on our website, so please visit us. We now offer advertising in our newsletter and webinars, so please email me for more information. All right, so we're going to go ahead and get started. Our speaker today is Jenny Clark from Solvability. Thank you for joining us, Jenny. We're going to be covering pricing and the must-win contract.
So thank you, Mallory. This is Jenny Clark with Solvability, and what we're going to be talking today are really pricing strategies. Now, of course, when you think about it, every contract may be a must-win, but what I consider a must-win is one that you've been targeting for a long time. It's a break into a new agency that's really going to accelerate your company forward in a big way. And because of that, you want to be very careful about pricing. You want to be as competitive as possible. And sometimes you want to know what are three scenarios, the maximum, the minimum, and the normal price for this service, so that if I get called and they say, we want your best and final offer, I know what it needs to be. So next slide. So what we'll be covering today in pricing and the must-win contract, this is really, for me, all related to small businesses in federal contracting, because that's always my focus. The companies that I'm working with have to be very agile and understand it, and so in some ways, it's a simplified version of what a company would go through as a larger contractor, but under a larger contractor, you've got CAS compliance and a lot of other rules, and a lot more structure to how you price, how you propose, and how you control. So we're talking about, number one, just some cost and pricing basics. We're talking a little bit about terminology, so we're talking about the same information. The second thing is, I always want to help people understand how they should know that their costs are covered plus a profit, plus a reasonable profit, and so we're going to establish that baseline and how you would be able to know that. In small businesses in particular, when there's a lot of growth going on, it's very hard to do projections. And so there's a certain amount of regular updates that need to happen to make it work. Then the last one is how I define the must-win, which I said is a new agency or a new line of business where they're going for past performance. And this one is a particular one that is really important to the company as a whole. And because it's going to increase the size of your company, you really need to know what would be the impact of that. Next slide. So what I've tried to do is on this slide give you some cost and pricing basics. And so let me slow down for a minute and go through this. Normally, I would have a spreadsheet up, and what I ended up having to do is type it into the PowerPoint. So maybe a little bit hard to read, but let's see if you can follow me. When I'm talking to people about their pricing proposals, what we're usually looking at is what labor categories are going to perform the work, how many hours of that labor category would it be, and then we're also looking at how many productive hours in a year that might be considered with that. So in my little chart, I've got 2 labor categories. So this is very simple, but you could put 16 labor categories, however you need, how many you need. And in my example, I list a program manager and an analyst. Now, normally in your more complicated proposals, you would have labor categories or average job titles, something along that line that you would use to come up with these average pay rates. In this case, what I did is put head count. The only reason I did that is sometimes to make my proposal easy for me to look at in my head, I'll use head count so that I know exactly how many hours and how many people I'm talking about to get the right total. I developed an average pay rate of $100 an hour, that program manager would be making about $200,000 a year. That's the rate at which we're paying that person. And then the analyst, I said on average, my analysts are costing me $50 an hour, or those are $100,000 a year people. Now, I just did that so those would be nice round numbers that I could do in my head in case somebody has to call me later and say, Jenny, your math was really wrong. I want to know that pretty quickly. Productive hours. In this example, I'm saying that these people are full-time for the year. And I'm also finding that in the proposal itself, in the instructions to the offerer, it told me how many hours to bid. Sometimes it does, sometimes it doesn't. But in this example, I came up with 1880 hours, 1,880. I come up with that because 52 weeks times 40 hours a week is 2,080 hours. I know that our company takes off 80 hours for holiday, and we offer or allow 120 hours worth of personal leave. Some of that gets carried forward. But from a pricing standpoint, we inside our company have come up with a rule that we're going to use 1880. You will see contracts where people come up with 1865 or 1900 or whatever it is. So you'll have to talk among the people that are looking at that bid what that number should be. I call it productive hours because although I'll pay my program manager their entire $200,000 worth of salary, he won't be billable for that many hours, so I only used 1880. So all I did in this example is extended it. One headcount times the pay rate times the productive hours is $188,000. I did the exact same math on the analyst. I had a headcount of 4, $50 an hour. Productive hour standard for that group is 1880, so it comes out to $376,000. When I add it all together, you can see I've got an average pay rate of $60, but that's not really an average. That's a sum of the two. There's no weighting in that. So if I was going to do this slide again, I'd put an X through that $60 an hour because it's not a true average. I suppose in this case it's a weighted average, but nonetheless. My productive hours is 9,400, and that's actually when you multiply the 1880 times 4. My total bid is $564,000. Now that's just the direct labor that I'm paying people. I have no profit. I have no amounts to cover my indirect burdens, such as fringe, overhead, and G&A. Some people would call it that's the direct labor. Some people would call it that's the raw labor. But whatever term you need to call it, inside your company, be consistent with how you name it and how you label it and how you talk about it, because it's very easy to miss it, and you could miss your bid by half, or you could overbid by double if you're not consistent in how you talk about it. Item 2 under cost and pricing basics is what I call FOG, the fog of indirect rates. FOG is shorthand to me for fringe, overhead, and G&A. So let's talk about those 3 components. When I hire somebody on, I put them on the payroll. I've sent them an offer letter. It defined everything that I'm going to provide to them because they're an employee of my company. Now, the first component of that is something they don't have a choice about, I don't have a choice about. That's payroll taxes. What we're talking about here in terms of payroll taxes are company-paid payroll tax expenses. That's going to be Social Security, which is 6.2% of the first 120,000 or so. Medicare, which is 1.45% of total wages. State unemployment, or SUTA, which varies by state, but if I was picking numbers out of the air, I'd say $250 a head per person a year. And federal unemployment, or FUTA, F-U-T-A, which is $42 a head per year. Those are my payroll taxes. I round those up to about 10%, and here's why. There's something that's not a tax technically, but we have to pay it, workers' comp insurance. Everybody has it. It's going to vary depending on the kind of work you're doing, but I just kind of lump that in as a statutory requirement, even though it's not payroll taxes, into that payroll tax line, and I come up with 10%. So if you're coming up with a payroll tax percentage between 9 and 10%, you're probably accurate. The second component of fringe is benefits, right? Let's do leave next. And I just mentioned that a minute ago when I was talking about paid time off and holiday. Some people have vacation and sick leave. Other people call it annual leave. Whatever you call it out, look and see what's in the handbook. Look and see what you're putting in your offer letters. Make sure it's consistent, but be sure that you understand what that's going to be. That I came up with a magic 10%. Here's how. As I mentioned, 2,080 hours in a year. That's 40 hours a week times 52 hours a year. So that's the max hours in a standard year. And don't ask me about leap years. You'd have to figure that one out yourself. Then I would next take, how much leave time do I have off? So again, go back to your company handbook. Do you offer 10 holidays a year, or do you add 10 plus whatever the president makes up on the last day of the year? Do you, so if you have 10 holiday hours a year, that's 80 hours for holiday. So you're expecting for people to take those days off, and you're expecting that they get that their normal pay for that week, and that's going to be their holiday pay is included in that. Then what I said is, on average, most companies offer either 40 hours worth of sick leave and 80 hours worth of vacation. A lot of companies have combined those two and now just call it 120 hours worth of personal leave. And that way the company is not really obligated to keep track of people that are taking sick leave because they're taking care of a parent or a sibling or an immediate family. And it kind of reduced the discussions about that. So just in round terms, look at your employee handbook, figure out how many hours of leave you've got, add up those hours, and either the standard or the average for your workforce, because if you've got a bunch of senior people, your leave that you're allowing may be more than 120 hours a year because they've been with you 10 years and it's 160. Take a look at that. But in my example, 80 hours holiday plus 20 hours worth of PTO is 200 hours divided by 2,080, about 10% a year. The third component of my fringe is my benefits. This is the company paid expense. So it's the company paid portion of health insurance. If you offer vision and dental and life insurance and short-term life and short-term disability and long-term disability, whatever else you add, 401k match is also part of that. Add up those costs and see what that is. If not everybody takes it, it might lower the overall cost. So in a way, in a lot of small companies, they'll even go to the trouble to figure out everybody's benefit cost and what each individual employee costs every single month. That would be precise. On the other hand, you're not going to fail to hire a new hire just because they want family health insurance. And so people are really playing a lot with health insurance and premiums with deductions. And do I cover single only or do I cover family and how I do it? That is so much a component of a company culture and benefits that you really have to think about it. But at the same time, you don't want to find out that in the market that you're in, you've got people sitting right across the aisle from competitors or subcontractors or prime contractors. You don't want your employees poached because you have not very good benefits when all they have to do is change badges and move across the hall and they'll get better benefits. And people will move for that because it's a big part of their compensation. I also put in parentheses, reduce from there. If I see a company that has a fringe benefit rate under 23% or 25%, I'm going to go analyze that and see what's going on because I find that to be unusual. In larger companies, your fringe benefit rate might be 37, 38%. Sometimes if people have a lot of NASA contracts, or it depends on your customer, how the benefit package is all worked out. The next thing I would say is the second component of the FOG is overhead. That's the support cost of your technical workforce. If people are working at a client site, so they're not in your building, honestly, you hardly see them. You know, you'll see them at the Christmas party or something. Oh, I've never met you. Which building are you in? There's not much overhead to support those people. You might have some mileage or some training, something like that. But I usually say about 2%. If you've got people in your building and you're providing the facility costs, you're providing them computers, all of those other things, The overhead rate for your company, you need to have calculated specifically for your company to know what it is. People always ask me, what's an average overhead rate for work in my office? And there's no such thing, because if you're a manufacturing plant, that overhead rate's got to cover a bunch of depreciation on the equipment you've got. If you're doing a training company, you hardly have any expenses outside that. Your overhead could still be high because your overhead is the cost of developing the training. So there is no average overhead at customer site, but I'd be glad to talk to anybody that had more questions about that. G&A is general and administrative cost. That's the cost of the back office, the cost of running the business, the corporate headquarters, the headquarter expense. I usually estimate that to be between 10 and 15% for a small company. If it goes much above that, you're not going to be competitive. If you go much below that, you're not going to have enough cash flow and profit coming into the company to fund your growth. So you don't want to go below that. Then the last thing is profit or fee. What are you bidding for, fee or profit? Many times it depends on the type of contract that you're going after. A fixed price, you might be able to claim more. On a cost plus, it's usually 6 to 8%. On a T&M, it's not necessarily revealed, but you need to make sure that you are profitable or you're not going to have any money. Next slide, please. What I've created here is just a little multiplier, and you're welcome to copy this and have it on your desk. And what you'll do, there's more than one way to calculate this rate, so don't go by this as being the gospel. There's another way to do it that's common. But normally what you do is for every dollar worth of direct labor, I'm going to pay 30% worth of benefits. And in this case, I wrote overhead including fringe. So technically in my case, that's probably 28% fringe and 2% for overhead. Then I multiplied 12% G&A on top of that. So I'm adding the 1 plus the 0.3 to get 1.3 times 12% comes out to 0.16. My burden cost then is 1.46. My fee, I apply to all of that cost. It's 10%, so it's going to come out to 0.15. Unrounded, it would have been 0.146. My fully burdened fee with multiplier, in this case, is 1.6. When you have this, I want you to build it and change 30 to 32. I want you to change G&A to 10%. I want you to change fee to 8% and see what that does, because that's what's called the multiplier. What happens is I've got 1.6. So what that means is down in the bottom in the yellow, if I'm paying somebody $50 an hour as an employee, that's a $100,000 salary, I would multiply that times 1.6. That'll give me an 80.10 billing rate. I've got to bill at least $80 an hour in order to recover all my costs and have a 10% profit. I can do that backwards. I heard from the customer, the last people we had were charging me $84 an hour. I'm going to use that business intelligence. I'm going to divide $84 an hour by my factors of 1.6, and I personally call that a multiplier, 1.6, and that gives me $52.43. That's the maximum I should pay an employee in this position to make my intended profit. Next slide, please. The main thing we want to do is make sure that you know your costs are covered. Your direct labor is the salaries for your billable workforce plus their leave, and you've got to take into account bench time if they ever have situations like that where they are not covered by a contract, but you have to keep them in the company. We talked already about the components of fringe, 401k, workers' comp, leave on seniority, payroll taxes. Your overhead costs, consider the amount of money and cost you're spending these days for recruiting and background checks, maintaining your security clearance and your certifications. And G&A, or general administrative, is executives, bid and proposal, legal expenses, HR, finance, and accounting. Next slide. Your must win is what you've got to do in order to win. And the reason I want you to take a look at this is to identify how you could use a little formula that I just showed you. And if you decided that that your normal is 1.6, but in order to win this contract, you're going to go to 1.5, what you're really doing with that is identifying that you've got to be more aggressive on pricing. The other thing you want to do is keep an eye on your cash flow situation. You want to be able to make sure that you've got basically 3 months worth of payroll to finance this, because otherwise you've got a lot of upfront cash to invest and you've got to be taking care of that. Next slide, please. Next slide, please. Oh, want to learn more? I went too fast, but nonetheless, if there is any information that you'd like to know, you can go to my website at solvability.com, and I've got a little wrap rate calculator. And what I do with that is take you through an exercise with the spreadsheet so you can start to learn this. So thanks so much, Mallory, for having this today, and I'll turn it back over to you.
Thank you, Jenny, for sharing your knowledge and insight today. Today's presentation has been recorded and can be found on our website or YouTube channel within about 48 hours. If you have any questions about today's topic, please contact Jenny at the phone number or email shown on your screen. Thank you, everyone. This concludes the webinar.